Imagine for a moment you're facing a financial market that's constantly shifting, where everything feels uncertain. Most people tend to look for stability, for comfort in strategies that have worked in the past. But as I've learned over the years, the real secret to success isn't about sticking to a fixed path. It's about flexibility, the ability to adapt when conditions change. That's what's always guided me. When the market turns, most see a setback. I see an opportunity to adjust, to pivot. For those of you who've lived a full life, like many over 50, this flexibility becomes even more important. Experience gives you an edge, but it also comes with a responsibility. Not to cling to the past, but to shape your future according to what the market presents. As you approach your 50s, many things change, both personally and financially. But if you look closely, you'll see that this period offers something invaluable: perspective. At this stage, you've already experienced the ups and downs of life. You've seen economic shifts, witnessed different financial trends, and felt the pressure of managing your own resources. That experience is priceless. You might think that the time for aggressive risk-taking is behind you, and in many ways, that's true. But here's the beauty. You've gained wisdom, a deeper understanding of risk, and a sharper ability to see potential. Now, rather than rushing into investments driven by the hype of the moment, you can make more informed, thoughtful decisions. The real advantage of investing in your 50s is knowing what's truly important. It's about more than just chasing returns. It's about aligning your investments with your goals and your values. You don't need to prove anything anymore. Your strategy should now focus on balance, growing your wealth while protecting what you've built. And the best part? You've got time to adjust, refine, and really perfect your approach. By the time you reach your 50s, you've probably heard countless stories about people who took big risks in the market, some that paid off and others that didn't. And you might find yourself wondering, is it still worth taking those kinds of risks? The answer is complex, but here's a guiding principle. Risk is not the enemy. It's the way you manage it that matters most. As you get older, your financial goals tend to shift. You're not just looking for quick gains, you're looking for security and stability. And while the temptation to chase high returns is always there, the most important question to ask yourself is, what's the cost of this risk? At this stage, it's about striking a balance between growth and protection. A common mistake people make as they age is thinking that they need to completely avoid risk. But that's not the answer. Instead, focus on risk management, spreading your investments across different sectors, balancing more volatile assets with safer, stable ones, and keeping a long-term perspective. By doing so, you'll be able to continue growing your wealth while minimizing the chances of a financial setback. One of the most important lessons I've learned in my career is that flexibility is the key to surviving and thriving in the market. The market is not static. It's a living, breathing thing, always evolving, always shifting. The strategies that worked yesterday might not work tomorrow. And if you're too rigid in your approach, you'll miss out on the opportunities that come with change. Flexibility doesn't mean abandoning your principles or being overly reactive. It means being open to new ideas, new trends, and even new risks when the time is right. It means recognizing when your current strategy is no longer serving you and being willing to adjust. For someone over 50, this is especially important. As you move through life, you accumulate knowledge, and sometimes that knowledge can make you feel like you have all the answers. But the truth is, the market doesn't care about your past successes. It only cares about how well you adapt to the present and future. Being flexible gives you the edge to not only protect your wealth, but also to position yourself for new opportunities that might otherwise pass you by. One of the most valuable skills in investing is the ability to spot market trends early. But how do you do that? It's not about blindly following the crowd or chasing the latest hot tip. It's about understanding the psychology behind the market's movements and seeing beyond the surface level. When you study market trends, you're not just looking at numbers or charts. You're looking at the bigger picture. How people are reacting, how they feel, and what they believe will happen next. This is where your experience comes into play. You've lived through economic cycles before, so you can start to recognize patterns that others might miss. The key is to position yourself ahead of the curve. Look for signs of change before they become obvious to everyone else. Is there a shift in sentiment, or new technologies or industries gaining traction? Pay attention to these signals. But it's not enough to just recognize a trend. You have to act on it. Seizing opportunities means being willing to take calculated risks when the time is right. By doing your research, staying informed, and trusting your instincts, you'll be able to take advantage of trends before they peak, maximizing your returns. Let me be clear. If you're not making mistakes in investing, you're probably not taking enough risks. In my experience, the greatest lessons often come from the moments when things go wrong. It's easy to celebrate the wins, but it's the losses that can teach you the most about your strategy and your mindset. When you make a mistake, don't shy away from it or try to ignore it. Embrace it. Take a step back, analyze what went wrong, and learn from it. Each failure is an opportunity to refine your approach and avoid the same pitfalls in the future. And as you age, the wisdom you gain from these experiences becomes an invaluable asset in your investment journey. The key is not to dwell on mistakes or let them derail you, but to use them as stepping stones to better decisions. Remember, even the most successful investors have faced failures. The difference is that they don't give up after a setback. They use it as fuel to improve, to adapt, and to keep moving forward. In investing, there's no such thing as a perfect strategy. The only way to get closer to one is to learn from every mistake, adjust accordingly, and continue growing stronger with each step. One of the most powerful concepts in my investment philosophy is reflexivity. Simply put, reflexivity refers to the idea that people's perceptions and beliefs about the market can actually influence market outcomes. It's a cycle where expectations shape behavior, and behavior in turn shapes reality. In other words, the market isn't just driven by cold, hard facts. It's also shaped by how investors feel and react to those facts. This concept is especially important for those of us in our 50s and beyond. With the experience you've accumulated over the years, you have a better sense of how emotions and biases can cloud judgment. The key is recognizing when sentiment is influencing the market more than fundamentals. This gives you an opportunity to either take advantage of overreaction or avoid making decisions based on fear and hype. For example, during times of panic, people tend to sell in a hurry, even if the fundamentals haven't changed. On the flip side, when the market is overly optimistic, you might see bubbles form. By understanding reflexivity, you can position yourself more strategically, making decisions that others might overlook or misinterpret. As you approach your 50s, building a diverse portfolio becomes more crucial than ever. When you're younger, it's easier to take on higher risks and focus on a narrower set of investments. But as you get older, especially if you're nearing retirement, the stakes change. The goal isn't just about growth anymore. It's about balance and protection. My approach to diversification has always been about finding a mix of investments that not only have growth potential, but also stability. A good portfolio should include a combination of stocks, bonds, real estate, and possibly even alternative assets like commodities or hedge funds. The key is to spread your investments across different sectors and asset classes to reduce risk and protect yourself from market volatility. But it's not just about quantity, it's about quality too. The best investments are those that align with your long-term financial goals. As you get older, you don't need to gamble on the latest trend. Instead, focus on assets that provide steady returns while keeping the risk manageable. At this stage, think of your portfolio as a shield. It should offer enough growth to sustain your wealth, but also enough protection to weather economic storms without risking what you've built. As you approach retirement, one of the biggest challenges is finding the right balance between growth and protection. The goal isn't just to preserve what you've accumulated, but also to ensure that it continues to grow, even if at a slower pace. At this stage, you can no longer afford to be fully invested in high-risk, high-reward assets. The volatility can have a bigger impact on your finances, especially if you're relying on those assets for income down the line. But at the same time, you don't want to become too conservative. If you do, your investments may not keep up with inflation, and you could end up losing purchasing power over time. The trick is to create a balanced portfolio that reflects both growth and protection. You can achieve this by blending more stable, income-generating investments like bonds or dividend stocks with a smaller portion in riskier assets that have higher growth potential, such as technology stocks or real estate. This strategy allows you to preserve your wealth while still participating in the market's upside potential. You don't have to choose between safety and growth. With the right approach, you can have both, ensuring your financial future is secure and your money continues to work for you. Looking ahead, the most important thing you can do as an investor, especially over 50, is make strategic, informed decisions. The market will always be filled with uncertainty, and while you can't control the ups and downs, you do have control over how you respond. The key is to remain adaptable, to stay informed, and to approach each decision with both your knowledge and your instincts. The strategy that worked for you in the past might not be the best one for the future, and that's okay. Being able to evolve is what separates successful investors from those who are left behind. Don't rush. Take the time to evaluate your options, understand the risks, and consider the long-term impact of your choices. Your wealth is not something that should be left to chance, but something you carefully nurture and protect. As you move forward, remember that flexibility and patience are your greatest allies. It's not about chasing every opportunity, but about recognizing the right ones when they come. You've got the experience. Now, with the right strategy, you can ensure that your future is even brighter than your past.